Here's just an outline of what we hope to accomplish and get through today. We're going to spend a little bit of time talking about what the states and federal agencies are doing from an examination posture stance, who's in banks, who's not, who's offsite. But where we really want to spend most of the time is discussing interagency examination COVID guidance, state federal coordination using that guidance, as well as to talk about current examination matters, to include what's working well in offsite, what's not working, your challenges, and really get into exam ratings with your feedback. We're going to wrap it up with a little discussion on current exam tools that are out there, as well as a brief demo of Project 5, and for those states who are getting that standard file format from your institutions. So at that, before we jump into the discussion, we do have with us today Indiana Commissioner Tom Fite and Ohio Commissioner Kevin Allard. Both of these guys represent the State Liaison Committee on the FFIC Task Force on Supervision, which is the group that's really having the discussion on current examination practices and processes. So I wanted them to join us in the discussion today, and want to turn it over to Tom and Kevin to say a few opening comments. Tom?
Yeah, thanks, Mary Beth. It's interesting picture you have pulled up there. I think looking at the picture you see on the screen now, in that picture, you would say, boy, pandemic's been pretty tough on that guy. He's let himself go a bit. So that's a fun picture to see. I actually haven't seen that suit now in about 7 months either. So I think my answer would have probably been better at C, the last question, right? Hey, thanks for letting us be here today, by the way. When Kevin and I both heard about this event, we were really eager to have as a participant, and especially give us an opportunity to speak for a few minutes, because this is really what we've been working on now for many months, is just trying to get better cooperation and better understanding about what's going on at the examination level, what really matters. So thank you very much for having us here. Obviously, Kevin and I know better than anybody the importance of examiners' jobs. We grew up as examiners, right? So we both been in agencies for a very long time, and we recognize that the examiner's work is really where the rubber is going to meet the road. It's really where you're going to find out those kind of things are going on in the pandemic. It's where you're going to really understand where the risk is in our bank. And it's also where we're going to learn from each other. And we've had some great examples of this the last many months as well, even up to including one state, shared with us that they created a ed module around the new examiner guidance, which I think is fantastic. So those kind of experiences and learning from each other is really valuable. And I think that's why we see now 315 people on this call today, right? I think it's just a really solid example, a really solid, I think, validation that this is what we should be doing. We should be talking about this kind of type of stuff. We also, better than anybody, recognize the difficulty that an examiner is trying to work through right now. That the toughness of your job is probably legendary, as far as this will probably be the toughest you'll have in your careers, I'd imagine. It's the toughest I've seen in my 20 plus years of doing this, just with the level of unknowns. It's difficult enough having to make tough calls as an examiner in tough times. We've done that before during prior recessions, but having to do that with very limited information, virtually no facts, and limited documents makes it really difficult. So we're talking about it, right? We're trying to figure out how do we do that, and are we doing it consistent or not? We, Kevin and I have somewhat forcefully, along with Mary Beth and a couple of others, started some discussions at the federal level that were a bit uncomfortable to begin with. The federal regulators are definitely very slow to want to converse with one another. I think that has to do with the fact that it's awkward to talk right now because there's not good answers for most questions. When there's not good answers to questions, I think people tend to show up. So we've worked really hard, actually, to force through that and to break down those barriers a little bit, and maybe even provide a little bit of a safety net to let people know it's okay not to have answers right now, but we should at least still be talking about good solutions when we can find them. So we've worked on that at the federal level. Certainly working that really hard with the FFIEC's Task Force on Supervision. So Kevin and I are the state representatives on that task force, which meets monthly. We actually just met yesterday. On those calls, we represent the thoughts and opinions of all the states. So when I say to you at the beginning, Kevin and I are excited to be here, we're excited to take notes, because we're going to listen to what all you guys are saying, and we're going to take that right back with us, 28 days from now to the next TFOS meeting, and tell them this is what state examiners are seeing. This is the things we need to work on. These are the things we need to be consistent on between state and federal regulators. Awkwardly, I would tell you, but before states really pushed on the topic, the desire to have a COVID discussion was so limited that even 2 task force and supervision meetings ago, so 2 months ago, basically, COVID wasn't even on the agenda. So that might give you a rough idea of kind of the flavor and the feel of this in Washington, D.C., and maybe the I guess, secrecy has pulled over some of this stuff at the federal level that we've had to work through. That being said, I think it's still been a barrier, but this is like a time like no other. And I feel like, and I know Mary Beth and Kevin would agree because we've had these conversations, this is exactly what the FFIEC was built for. You know, when you think of what the FFIEC's mission is, and if you want to pull it up and read it, it's an interesting read. It's very straightforward. It's all about collaboration and consistency. It's what you would expect from state and regulators at a time like this, right? So when you think about that FFIEC's role and mission, I think it provides Kevin and I a really, I think, meaningful mission right now to make sure we carry that through TFAS and also through the SLC and other places we have touches with the FFIEC. Recent successes have been good. So our meeting yesterday was great, as a matter of fact. We've talked about exam posturing a lot. We know a lot now about where each agency is on exam posturing as far as what they're telling our examiners to do. We know the issues and challenges that they're seeing, including some of the things with off-site supervision. We've had a lot of discussion around rating challenges. I know it's going to come up on this call today. I'd be surprised if it didn't. I'm looking forward to hearing your comments and questions about rating challenges. There's even been some talk about possibility of doing some case studies around this to be able to provide maybe, I don't think better guidance because that's going to be difficult to do, but maybe at least a better understanding of kind of the awkwardness and the types of facts and things that are coming into ratings right now, and maybe understanding a little bit better where the cut line might be for 1, 2, 3, 4, and 5. The FDIC has came quite a long ways with this. I would give them credit. Should have recently received a report with all your PPP and 4013 loan modification totals for June. If you haven't received that report from the FDIC, please let Mary Beth know. She'll make sure that we get a message to somebody at the FDIC to get that for you. I would say you should have received that in the last 2 weeks. I would imagine it went straight to your commissioner, so maybe start there first and ask the commissioner if they got it. But another good example there, I think, Bill, where with the plug-in and trying to work together, we can save each other a lot of time. So I don't want to take up all your time today. It's definitely more about you than me. We came to absolutely listen. So probably all I have to say today. Kevin, you have anything to add?
Sure. Thanks, Tom. I don't think I have quite the growth going on, but I am more gray, and I don't think I even own that suit anymore. So wanted to share a little bit at the CSBS level, some other work that's being done to coordinate efforts with regard to the pandemic. Tom and I also participate on CSBS's COVID task force with some of our fellow commissioners. The group was discussing supervisory matters and was set up to coordinate the work of existing policy committees and boards related to the COVID pandemic. The scope of the task force work thus far has included developing an inventory of lessons learned and best practices to COVID in the areas of operating status and supervision and examination postures. The group has also been discussing off-site and on-site examinations, reviewing examiner guidance, discussing data and risk posture, reviewing examiner tools and work programs, and notifications provided by federal agencies. We have also been discussing examiner and industry training, just like today's event. The scope of the group's work will also include any recommendations for necessary changes to state or federal law to improve operational flexibility, information sharing, and coordination. CSBS also has developed a Yammer page that has about 100 participants thus far and a very robust COVID resource site. If you're not a part of the Yammer group or have not visited the site, I would highly encourage you to do so. Most importantly, as Tom mentioned, we want to hear from you today. We want to know what your experience have been with off-site examinations, good and bad. We want to know what you've been hearing from your federal counterparts and what you are seeing in your institutions as we're 6 months into this pandemic and the economic impact. As a state regulatory community, we really want to hear what we can do to help you do your jobs. Thank you for participating, and I very much look forward to the conversation this afternoon.
Excellent. Thanks, Tom. Thanks, Kevin. We appreciate you being here and listening to the discussion, and we know that you're going to represent all the states well when you're meeting and talking with the federal agencies. And feel free to participate in today's discussion also. I don't want you to just sit there and be quiet. So let's jump right in. So first, I just kind of want to start at the state of the state. Like, what have states been doing over the past 6 months? Jamie, if you want to hit it to the next slide. Earlier this spring, and then again this past summer, we surveyed your commissioners to just get a sense of what your departments are doing from an examination standpoint and what your commissioners are thinking is going to shift by the end of the year. And, there's nothing really surprising here. As of the June survey, 95% of the states were doing 100% of their examinations offsite. There was 5% that was doing some portions of the exam on site, and I think that was really focused on the loan review piece. They would send 1 or 2 examiners maybe on site to either look at the files, scan the files just to get the information. But we did follow up with the question, like, what are you thinking for the end of the year? By the end of the year, do you think your examinations on-site, off-site mix will switch? And this was a bit surprising to me, actually, because what came back was that 41% of the states felt that they would do some sort of mix with some parts of the examination on-site and others off-site. And again, with talking with commissioners, I feel that this is that they may send 1 or 2 examiners into the institution, either do the final exit meeting to look at loan files or again to pick up documentation. I don't think it's on-site examiners for a week or 2 weeks, but parts of the exam and going in and out. But again, the number did surprise me. We do plan to send a follow-up survey just so we can keep current information within the next couple of weeks, and then it'll be interesting to see what the trend is and if any of these numbers are shifting. We also asked this, your commissioners, what is the return to work look like? And 85% of states currently have less than 10% staff in the office. So I think there's skeleton crews going into your state departments, or at least headquarters, just checking the mail, being in the office. Maybe that your IT support staff are in the office, but for the most part, most staff tends to be offsite, which is not surprising. With that, I'm going to turn it over to Jamie. She's going to give you a sense of what is happening at the Fed and the FDIC.
So good afternoon. Thank you. So the Fed and the FDIC, so the Federal Reserve right now is currently off-site until Q1 2021. The FDIC, on the other hand, is off-site until the foreseeable future. And however, they could be going into some high-risk financial institutions before the end of the year if it's deemed necessary. So from a supervision standpoint, the Federal Reserve is currently off-site monitoring their high-risk institutions. During the exam cycle, they are adjusting the scopes. And the toolkit that they have developed for examiners is really in line with the guidance. And so right now they're examining their high-risk institutions, and they're obviously coordinating those, the need to go into those institutions with the states. Also, they will be doing limited scope reviews of those high-risk institutions that they've identified. And also of note is that all exam downgrades are coming to DC for review because of the consistent approach that they want to take across all Fed Reserve banks. So you may see that if you're on a joint exam and you are examining an institution and there are potential downgrades, before the Federal Reserve can sign off on those downgrades, they have to receive approval from the DC office. It shouldn't extend the exam process too long. They said it's about a week turnaround, but that depends on the nature of the downgrades. From an FDIC perspective, they're doing off-site exams, but they're continuing their regular full scope examinations of their institutions. What they are doing is have increased monitoring of financial institutions that are under $10 billion. And that is the RD memo that they released, which highlights their approach to that temporary heightened monitoring program that they've instituted. And again, it outlines the framework, how they're inventorying those financial institutions that are deemed the need for heightened monitoring, how they'll contact the financial institutions, and release examinations. And again, the purpose of the FDIC's heightened monitoring program was again to develop a framework to promptly address and determine any risks in institutions that are resulting from the pandemic. So again, two different views as to how exams are going right now between the two federal agencies, the Federal Reserve's approach and the FDIC's approach. So we just wanted to make you aware of what the Federal Reserve is doing and what the FDIC is currently doing as well. So with that, I'll turn it back over.
I want to bring up the topic of the interagency COVID examiner guidance, which Mary Beth and the commissioners mentioned earlier. And really the reason this came about was because the federal agencies working with us wanted to have a uniform guidance for the examiners about what they should be looking at during examinations during the pandemic. And at the same time, it was released publicly because they wanted to give the bankers the same idea of what to expect during the pandemic. And it really goes through all the CAMEL areas to try and give a little bit of background, a little bit of guidance to the examiner working on exams right now. And we can go to the next slide, I think, Jamie, because we want to do a poll to find out how familiar you are with that guidance before I spend any more time talking about it. So the poll is, you do it the same way as the last one. And your polling questions are, see if this shows up, no. So the question is, how familiar are you with the guidance? And your choices are, what guidance? That's A. Or I looked at it, that's B. Or I use it on a regular basis, that's C. So give me your response to how familiar you are with the interagency examiner guidance. I apologize, I should have given you the full name because I'm sure you're more familiar with it from the full name, which is the Interagency Examiner Guidance for Assessing Safety and Soundness, Considering the Effect of the COVID-19 Pandemic on Financial Institutions. So again, if your response is what guidance, that's A. If your response is I looked at it, that's B. And if you use it on a regular basis, your response should be C. Jamie, are we getting some results? You're on mute.
Jamie, I think you're on mute. Read out the result.
We are. We have 71% reporting that they have looked at the guidance. 11% responded that they are unfamiliar with the guidance. And 17% have reported that they are using the guidance on a regular basis.
Okay, thanks, Jamie. We can move on to the next slide. I just want to give kind of a high-level overview of some of the features of the examination guidance. Again, it was released at the end of June, and there was a rapid response on this topic, which you can go back and watch if you missed it when it came on. It was originally held on July 2nd, but it was recorded, so you can still go back and watch it if you want. But I just want to talk at a high level about some of these areas in the guidance. The guidance highlights the importance of a risk assessment, and it talks about the bankers making a risk assessment of their financial institution, incorporating all the knowledge they have about what's going on and maybe also incorporating what they don't know about what's going on. And this is a very important part of this guidance because we know as examiners go into institutions, they're going to look at the institution and how management is dealing with a pandemic, and looking at a risk assessment like this is a good way to get a handle on that. Now, obviously, a risk assessment is not a one-size-fits-all kind of prescription. For a very large bank, a risk assessment is going to look very different than for a community bank, small community bank. In fact, in a small community bank, you might get a really good idea of the risk assessment just by talking to the CEO. So you as an examiner are going to be the expert in what's for that institution, for that locality, what is going to be a good risk assessment. Some of the other areas, as I mentioned, it does go through all the CAMELs, talks a little bit about each one of those, and it provides you just a little bit of background about what to look in all those areas. That's all right, Jamie, you can go to the next slide. So I want to give a shout out to Connecticut. When the guidance came out, they went through and said there's an awful lot of steps here that examiners are expected to do or could be expected to do. And so what they did is they pulled all those out of the guidance and made like their own version of an ed module that just goes through all the things in the guidance. If you haven't already seen this, I encourage you to go to the Examiner COVID web page on the CSBS site and look at it, because you might get some ideas about things you can be doing in your examinations based on that work that Connecticut has already done. I think Kevin mentioned this resource page on csbs.org earlier, but really we're trying to use it as a way to capture a lot of really good information for examiners. And we also encourage you to submit things to that page if you've got things like this ed module that Connecticut did based on the guidance that you think other states would benefit from. We'd love to have you send them in. We can go to the next slide. One of the things that the interagency group that's been working on the guidance and other issuances like that has been working on since July 2nd is some frequently asked questions, or a question and answer document. The intent is for the Fed, the FDIC, and CSBS to issue these questions and answers back to our various departments. And because only the three of us were involved in the rapid response, the other agencies weren't involved in the rapid response. And if you registered for the rapid response in July, when these frequently asked questions are completed, you will automatically be sent from the rapid response system this document. But I just wanted to give you a little preview of the kind of questions. So here's a long question about TDRs that is basically the question is about how long can a Section 4013 loan modification be? And the answer that you'll get in the final document will be much longer than this, but there's no statutory restriction on how long a loan modification can be to qualify under Section 4013. Section 4013 established this special loan modification category that's not a TDR, and there's no limit to how long those modifications can be within that document. A couple other things to remember, though. Even if a loan meets the Section 4013 requirements, the institution is still assessing it, the credit quality of the loan, and is expected to maintain an allowance for the loan based on the credit quality of the loan. Another question, just an example, is about earnings. And we also have gotten a question about earnings that we're going to get to in a little bit, but I just wanted to highlight the kind of the flavor of the answer that we expect will come on this kind of general question about earnings. Examiners are not expected to kind of gauge the duration of the pandemic. But what we're asking them to do is assess whether management's projections are reasonable and supported. And again, the local examiner on the ground talking to that banker is going to be in the best position to make that decision. Want to make sure that as an examiner, you're considering management's assessments of risk related to the pandemic, considering the size and complexity of the institution. And you should also be mindful, and the guidance also says this, you should be mindful that the localized impact of the pandemic may be very, very different from a regional or a national impact. Each institution is going to be affected in its own way by this institution. So let's talk about, let's do a new poll about the guidance. We want to know from your standpoint, what works, what doesn't work. And yeah, you can go ahead, Jamie.
This is a discussion, not a poll. Go back, Jamie. We just want to open it up at this point to hear from you all these questions. And I think if you hit raise your hand mark, Katie will turn on your microphone so that you're not muted. So this is your turn to talk as a part of the presentation. Katie, are you getting any comments?
Do not have any raised hands yet. Again, just to go over it, so in your participants list, if you open that up, you'll see a little hand button on the right bottom. You can hit. And it looks like we do have a raised hand now. So Teresa, I'm gonna go unmute you.
Hi, can you hear me?
Yes, we can hear you.
Yep.
Okay, great. So what we have seen in Maryland that has worked is our bankers have really taken the approach to really understand their borrowers and their borrowers' businesses, and specifically more the ancillary businesses that are affected by what's going on in the local environment. And I'll give an example. I spoke with one of my CEOs earlier this week, and she said that, you know, with schools not opening, with in-person opening and it being virtual, that she went around to, you know, her loan officers and said, what business do we have that are, for example, bus companies, school bus companies, because that's an ancillary business that's affected based on the decision whether a school is going to be open in person or whether it's virtual. So it's assessing that, it's contacting that customer, that borrower, and finding out about what's going on in their particular business. And she said everything is still going as planned. They are still buying and having to get new buses. They are still creating the schedule with the various school districts that they service. And moving forward with the anticipation that, yes, at some point, there will be in-person school, although there could be a combination of virtual or in-person. So we've seen a lot of that happening. We've seen a lot more communication with our bankers and borrowers about their businesses, especially those that we tend to feel are more like high risk because of COVID. You know, the hotel industry, the restaurants, those types of eateries, those types of businesses that seem to be more heavily affected. And it's proven to be beneficial because they're very forthcoming with information. They look at the institution as a way to help them. And of course, PPP helped significantly with making sure that they were able to meet payroll in that regard and even keep their businesses going for periods of time. But we've seen our CEOs and our, you know, bankers, not just their CEOs, but we've seen them take a different approach to the interaction and communication with their borrowers and the different dialogue that they have now because of COVID.
So actually they're having maybe better discussions or more discussions than you would previously see?
They're having more discussion about the effects of the pandemic on their business and also what that business's, you know, disaster recovery or business recovery plan is. And one of the things that my bankers have also told me is that, for example, restaurants, if the restaurants were able to reinvent themselves from what they were before, those have been doing very well. With carry-out business, they have less overhead because they don't have their dining rooms open. So it's a carry-out business that's been keeping them alive, and they have actually been doing very well. I was surprised to hear that.
Anybody else have any experience with the guidance or working with their bankers, what they're hearing about, maybe what missing from the guidance or industry response?
Right, we have another raised hand. So Michael, I'm going to go ahead and unmute you.
Hey, thanks. Yeah, Dan, you know, you mentioned the TDRs and the 4013 report. You know, there's some confusion there, I guess. Just looking at these modifications as they keep going on, if we get into a second set or a third set, you know, at what point is the expectation going to be for the banks to really look at these from an impairment standpoint? I know the guidance sort of generally addresses provisioning, but you know, at what point do we get concerned about the ability for the customer to repay full principal and interest when we're looking at lower cash flows and interest-only modifications?
Right. I mean, that's going to be the hard work going forward, right? Is figuring out what's the exposure on those individual loans. And you know, cash flow information, it's interesting that you bring that up because that's something that we've been having some talks about, kind of what are banks going to have in terms of cash flow information to demonstrate either cash flow ability or not, and how is that going to factor into the reserving? Just because a loan's been modified doesn't mean you don't have to take a reserve. So, you know, the work of loan analysis still has to go on, and that's it's been a little bit of a sticking point. I think not a big one, but I think it's been a little bit of a sticking point in kind of like, well, haven't I put my loans in this safe harbor now? But it's not a safe harbor. It's just simply not a TDR.
So I have another raised hand here. So Kevin, go ahead and unmute you.
Okay. Hello, how are you doing? My question was regarding section 40, the section 4013 loans, and how are examiners viewing those section 4013 loans versus the regular modifications that came out in the guidance, but the guidance before the CARES Act actually came. How is that being interpreted? I guess how is that being interpreted as to how institutions kind of classify those loans as to whether they should be section 4013 loans versus the ones that fall within the guidance? And I think one particular point about that is just how it gives them the option, if there's not a CARES Act loan, so to speak, it gives them the option to assume that the borrower is not experiencing financial difficulties. And so from my standpoint is that kind of those institutions that are just doing kind of blanket modifications in terms of just individuals coming in and they're not really doing any kind of case by case or analysis of financials or anything of that nature, and they're just kind of giving just blanket, and then most of these are short term, but just kind of wanted to get a flavor or a feel for what everyone is seeing, or just any thoughts on that.
Yeah, I'd like to hear anybody else respond to that.
I have a raised hand here from Chris. Chris, I'm going to unmute you.
Thanks, Katie. Yeah, this is the question that Kevin asked is something that we talk about. It seems like almost daily now. Is getting to be daily. Early on there was that kind of, okay, we're throwing everybody in this bucket, and we'll just see how things progress. And I don't know how many people thought it would be probably the 9 months to a year, or however long this could go on. But as we talk to our bankers about what do you do in the second time around? So I think the first time around, it's really a wait and see type thing. There's so little information out there that kind of give the benefit of the doubt, and we're still kind of in that phase, obviously. But second time around, what type of analysis are you doing to show that they need the modifications? We're hearing in some cases that a lot of the borrowers don't need them anymore. And if you are getting them, what type of analysis are you doing to show what their financial condition is, and just not giving additional blanket ones? But I think, Dan, like what you said, this isn't a safe harbor. It just says throw everybody in there and you don't have to recognize the risk. And that's really what we've been talking to our bankers about, is it's okay to do this and make these modifications. But just do the analysis to show, is this loan having issues that are going to possibly prevent repayment for the long term? It's just not a short cash flow bit that don't have sufficient sources to cover that and work through it. But if we're showing that the balance sheet's materially impacted by this, and it's going to be based on projections multiple years to work out, or maybe even based on projections that they're providing, they might not be able to work out it without additional accommodations. Then you've got to recognize that individually. But we're dealing with the same thing that Kevin mentioned, is you got these big blanket first timers that are coming due here or just came due. What do you do the second time around? And I think from what we're hearing from our institutions mainly is that they're taking a lot closer look. We're seeing the second time deferrals go down quite a bit, and really only giving them to people that really need them. But I don't know if that's the case everywhere.
Yeah, I think that's a good point, Chris, and I think that's what you would expect to see, maybe what you would hope to see. And, as you said, that individual loan analysis, there's no substitute for that, whether you're the loan officer or the examiner. Unless there's anybody else with a hand up, Katie, I think we can move on.
Yes, I don't have any hands up.
This is a question that we got on the Yammer page, and I just wanted to bring it up to kind of get y'all's thoughts on it. And really the question is, how do you think about core earnings in this pandemic? The earnings section of the guidance is a little bit vague. I would agree with that statement, and discusses the impact to core earnings from the pandemic. But if we're adjusting core earnings for the negative impacts, the provision, operating expenses, then shouldn't we also be adjusting it for maybe the PPP fee income that's being generated, higher mortgage banking from the low rates, strong deposit growth, which a lot of institutions have seen throughout this pandemic as there's been a flight to quality. So I'm interested in y'all's views on this. What do you think about review of earnings and how you consider it during this pandemic time? Anybody seeing any earnings upgrades?
I have a raised hand. Rochelle, I'm gonna unmute you.
Hi, thank you. So I'm currently working on a bank and I'm suggesting a downgrade to earnings. Not specifically due to the COVID deferrals per se, but the Fed funds environment, which declined significantly since last year, 2.5 basis points, has really hit their income, interest income earnings. And also the implementation of CECL, they're having to fund provisions. So I personally look at their earnings in the entirety, not just the negatives, but also the positives. I did try to account for their PPP fee income, and it just wasn't supportive at that time either. So I don't know if that helps, but I didn't specifically have a question.
No, I appreciate hearing your experience, though. Anybody else have any experience rating earnings, either good experience or bad experience?
I have another raised hand. Jill, I'm going to go ahead and unmute you.
Hi, we have been adjusting earnings for both the income and the expense. In some cases, it makes a minimal difference as they've been having a lot more expense provisions, and then there are some banks that are actually giving bonuses to their employees because the PPP loans were just, it took a lot of their time. So I just wanted to let you know what we're doing in Wisconsin.
Great. It's nice those employees got rewarded for all the overtime I'm sure they had to put in to get those PPP loans approved.
Right.
Okay, thank you, Jill. Next up, we have Steve. I'm going to unmute you.
Hello.
You can say your state as well. That'd be very helpful.
Okay, this is Steve from Indiana, and I recently reviewed earnings, and I kind of had to do an assessment of their numbers because they did a budget and then they revised their budget. They had a huge provision expense, but it really was not COVID related, but it was credit risk related. So in my revised estimate, I just told the reader, this is the volume of fees they might receive by the end of the year for the SBA PPP loans. And then my provision expense assumption, which I got from the bank's revised budget. And then the securities gains year to date, because I had a lot of securities gains. So I pretty much went with the actual June 30th numbers and annualized those. But a lot of times, if you just show your assumptions, in your estimate at the end, I think that is helpful. This bank, it was a little easier because their earnings had fallen so far down that it was definitely not going to be a 2. So it wasn't really a fence sitter. But I think most of the institutions that I've been in, there is some assessment of how the SBA PPP fees are going to impact the institution, how deferrals might impact the institution in terms of the volume of lost interest income, and then most of our banks have done a COVID provision expense. A lot of them did it late in the first quarter and some did it in the second quarter. So it depends on the bank, but those are kind of the highlights of what I've seen lately.
Sure.
Yeah, I have a follow-up. Sorry, Dan. I have a follow-up. Just curious. I see Matt Harvey added some statements in the chat. Thanks for that. Thanks what Washington's doing with some ratings. I'm just curious. Jamie mentioned that both the Federal Reserve and FDIC have put processes in place, and I'm going to call them review vetting processes on downgrades. What are your agencies or your commissioners, deputy commissioners, what are you all thinking regarding if you're going to downgrade? Do you have to run it up the chain in your office, or are examiners, EICs just given the go-ahead, just for consistency purposes across your institutions throughout your state? Are there any processes that have been changed as far as evaluating ratings and downgrades? You can either put it in the chat if some of you have put processes in place, or if you want to raise your hand and chat about it, that would be great also. Any raised hands, Katie?
no raised hands, but I do have a few messages here. So Sean Starr in Ohio, we vet all ratings through the office on each exam. From Jill, no change in processes. We always run it by the supervisors. And then Rochelle says no changes, need to get the buy-off from our portfolio manager. Melissa Sneed, we are using normal review processes. Tracy Bergman, we haven't really seen any downgrades yet, so we haven't put in a new process, but we are trying to talk about what we are seeing so we stay consistent across the state.
Excellent. Thank you all for that. And if you want to continue put in the chat, we're able to save the chat afterwards, and that will be helpful. And this is just something that we were just kind of curious from a standpoint in discussions with the Fed and the FDIC. And I do appreciate what Jean St. Andrews is commenting regarding the interagency guidance, that sometimes interagency guidance, joint guidance does not necessarily turn into joint interpretation. And I think that is, the point of this discussion for us to ensure that what you state bank examiners are seeing and doing and rating is in line with the Fed and FDIC and vice versa. And as you're starting to see any variances or any challenges or issues with the FDIC or the Fed, it's just helpful for Tom and Kevin in particular, because this whole discussion around consistency, consistent exam approaches within agencies, also among the agencies, is getting a lot of attention. So I appreciate those comments, Jean. Dan, do you want to move on to the next slide and do another poll?
Yeah, let's do a poll. Okay, everybody get ready. The next poll is about how your bankers have responded to the examiner guidance.
So what I'm going to do is briefly, Katie's going to log in and she'll be able to share the poll.
Oh, great. Thanks. So either bankers say the guidance is weak, bankers say the guidance is comprehensive, or the bankers say guidance is a good start but needs more details. And we got some voting going on. This is fun when we can watch the voting. So my question is going to be, what details do your examiners or your bankers say they would like to have elaborated? Put those in the chat if you've got some specific ideas for areas that your bankers have been saying they would like more, because that's the kind of thing we'd like to know about.
I'd like to just put a reminder that if you change the chat to everyone, it should be the very bottom option. That way everybody can see the chats that you're sending in.
Okay, that's it. We got a pretty strong readout on that one. I look forward to reading your chat.
Yeah, I think this is consistent with our conversations with the Fed and FDIC, that they're reporting back that they're getting positive feedback from their bankers regarding the guidance, but bankers are stuck on this whole TDR, and when is an accommodation become a TDR, how long, just like what you all were talking about earlier. They're also very worried about how management and asset quality will be examined. I know Doreen Eberly, the head of supervision at FDIC, said that their response as FDIC to those statements is that just because we criticize your assets does not mean we are going to criticize management. Some of these loans will get criticized, right? But that doesn't mean management is going to get a bad rating. But this is in line with what you're seeing. But I agree with Dan. If you want to put some thoughts on what your bankers say would make the guidance better, if you want to share that with us, that's helpful. Because who knows, we may work with agencies to update the guidance or issue an addendum or do a webinar for our industry on it and have these discussions. All right, so with that, let's kind of kick it into actual exam matters that you're seeing regarding your offsite examinations. Throughout the past several months, we've heard from you all either through our committee work at CSBS, through interagency meetings, and through you all send in emails. But here are just some of the challenges that we are hearing a lot about over the past several months, and then we want to turn it over to you to hear what your challenges are. But clearly, The exam schedules themselves are challenging. Exams are taking longer. Offsite is just not as easy. You can't walk down the hall to talk to the banker or the loan officer to get your information. You have to schedule calls or video conferences. So exams are taking longer. Some states are running into challenges with their exam schedule, the mandates, and are working with the Fed and the FDIC. And the Fed only doing the high risk institutions now and not sticking with the schedule is causing some issues for some states in your exam mandate. So number one, that's what we're hearing. We are hearing that, obviously data, everyone's saying if we only had better data, if we only had more real-time data. The June call reports just came out, and between the June and September call report, a lot could change. So some states have always had in place, Arkansas comes to mind, that their banks have to file monthly call reports. So they have more timely data than quarterly data. I know the CSBS data analytics team, Brandon, which many of you all are familiar with, have been working on our products, which we'll talk about here in a little bit. But data is a challenge. Even your bankers getting data on their borrowers is just a challenge on what their status is. Let's see, file sharing, especially in the beginning, this was really a huge issue for examiners. When everyone overnight moved from on-site to off-site, it put systems in overload. FDIC Connect could not stick with or could not deliver the needs that it was getting asked for. It was kicking people out. The large files were not getting through. Some state examiners could only use FDIC Connect on off hours, which was a challenge. But we had discussions. We looked at other options. A lot of states started using other platforms like Box. Even the Federal Reserve's Interlinks was used more than FDIC Connect. We surveyed the states just so we had a sense of what are the options that are being used. And I think where we are today, unless I hear otherwise from you all, you're in a better place. FDIC Connect is performing better, but you have other options. You've got backup options, whether your department started to use CSBS Box or your own state agency Box, or other off-the-shelf platforms for file sharing. I feel that we're hearing less about that, and you all are working through the challenges. I would say the number one issue that we hear most often from examiners is how do we do loan review on those banks that are not imaged and we're off-site? We are hearing a lot of challenges about that. And I think when we last surveyed your commissioners, you are asking the bank to scan the files, and that is the only solution that seems to be working, or the most popular solution. And your banks are willing, even though it is time consuming and a added burden to the institution, they're willing to scan the files that you need to do your reviews. And some states have sent, like I mentioned earlier, one examiner, even if it's to drive through to pick up the files, or send an examiner into the institution to actually do the scanning. But the non-image banks is definitely the challenge, and it's a challenge for the Federal Reserve and the FDIC as well. And the Federal Reserve has come out and said that they will not do any in-person examinations. So they are really struggling with what to do with their non-imaged institutions and how to get the files, because they don't want to ask the bank to do the scanning. So with that, we have another poll just to hear what other challenges you are having. So this one's going to be a little different. Instead of texting A, B, C, or D, we're going to ask you to text a word. So I don't know where it is, but the question is, what is your top examination challenge today? If you have to look at everything, you as an examiner, what's your biggest challenge? And if you just want to type that word to 22333, we're going to get a word cloud here, and we'll see what everyone has in common and what the number one challenge is. Just go ahead and type whatever word. I don't know if it's not working or if it is working or we're just not seeing it yet. So someone in chat wrote non-image bank, so that still seems to be an issue. Someone says communication, that I know is an issue, and a lot of states are working on what video conferencing software is available. We mentioned to the commissioners and the deputy commissioners last week that the Fed and FDIC have signed off on WebEx and Microsoft Teams for their video conferencing. And I know some states are using other platforms like GoToMeeting, Zoom, etc. But the Fed and FDIC can only participate in WebEx meetings and Microsoft Teams, and the Fed will be in Microsoft Teams next year. So I don't know, Katie, is this word cloud working, or should we move on?
Yeah, it looks like it's still loading, but I'm not sure why they are not appearing yet.
Okay.
But I can pull it afterwards and send it out to everybody.
Okay. Someone wrote in chat logistics, and Michael, I might need to just hear a little bit more about what the challenges are logistics. I'm assuming because you're off-site and not able to see the bankers and have face-to-face conversations. Clearly, CSBS has to work on our technology and our polling process. And maybe when we have a similar call in a month or so, we will have this worked out. So with that, Jamie, I think I'm turning it over to you, and you have another polling question to ask. You're on mute, Jamie.
So areas of concern, asset quality and allowance calculations seem to be two areas that we have discussed earlier that you all brought up. But again, we're starting to hear that segments within the credit portfolio, examiners are starting to look more at those CRE portfolios, hotel portfolios, restaurant portfolios, and really taking a hard look at how the bank is assessing those portfolios. And then we talked earlier, the cash flow projections question came up. So that continues to be something that is an unknown at this point, especially going forward. What's the probability of those businesses that don't cash flow or can't cash flow, and how, what the bankers have to do about that, as well as the examiners. And as for the allowances, we're hearing that some institutions, especially the smaller institutions, are increasing their provisions due to the potential risks that COVID could present, while more complex financial institutions seem to be spending a lot more time studying, analyzing, breaking down the portfolios based on what they need. So, and we did hear that Maryland did mention that they're seeing in their financial institutions a lot more emphasis spent on looking at the specific businesses and how that would factor into allowance calculations. So uncertainty still seems to be a factor within the allowances. But this is a time that we want to hear from you. What areas of review concern you the most for the next 6 months and into the year? Katie, if there's anyone that has their hand raised, we'd love to hear from the audience what you're considering as your concerns.
Are we doing a poll here?
Nope, this was examiners, just feedback, what they're hearing. If you can put anything in the chat functionality.
I think I might have a raised hand, Teresa. I'm going to go ahead and unmute you.
Great, thank you. Can you hear me?
Yep, can hear you.
Great. Okay, great. So right now with the June 30 numbers, that does not show the true picture of the condition of our banks, because with the deferral period, since that was contractual, they don't show up as delinquencies. It's not until after that initial 90-day deferral period where our bankers are going to go back and talk to those borrowers and see where their position is with their businesses, and whether they're able to pay principal and interest going forward, or if an additional 90-day deferral period extension is required. So I anticipate that the true picture isn't going to be in the 630 numbers. It's going to be starting with the September 30 numbers and well into 12/31 numbers and into the first quarter of 2021, when those deferral periods are gone, whether the businesses are going to be able to, borrowers are going to be able to pay P&I, and what they have done since then to either work with their new business structure and be able to make payments, or any arrangements that they may have made, whether it's a TDR with the institution, whether there's a concession that's made, or some type of a modification to assist them further through the deferral period. So I anticipate it's going to be the second half, the fourth quarter, when we start seeing those numbers through the 930 numbers and well into next year. But I think we're going to see it hit a little bit in earnings. It'll cause higher provisioning for those problem credits. And not all businesses are going to be able to make it through COVID. So you have a lot of businesses out there that are struggling if they haven't already closed. And at some point, they're going to have to come to the determination of whether, am I able to keep my business open, or am I going to have to close it? And, depending on what that decision is, it's going to directly affect their institution as well. So we haven't seen the worst of it yet. It's coming, but it's going to be starting with the 930 numbers.
Excellent. Thank you for your assessment, Teresa. So we'll go ahead and we have a poll for our next question regarding management addressing and identifying pandemic risks. So the question is, what are you seeing in the current exams? Do you believe management is appropriately identifying pandemic risks with respect to lending operations and other areas affected by the institution? And again, it's the same 22333 number. Well, that's okay. We'll get the results after. So we'll go back to the presentation. So examination ratings, again, we already touched upon this briefly earlier with regards to component and composite ratings and factors that are contributing to downgrades within review areas such as management, asset quality, and earnings. And we heard from you earlier that you have different processes in place within your banking departments as it relates to upgrades and downgrades in your current processes. So I'll turn it over to Mary Beth regarding joint examinations.
All right, thanks, Jamie. This is, just to get your thoughts on any comments, concerns, issues, what's working well, what's not with your joint examinations with the Fed and the FDIC. So if you want to raise your hand or use the chat feature just to share what you're seeing in the joint examination process or ask any questions, that would be great.
All right, I have a raised hand here. Eugene, I'm going to unmute you.
Hi, this is Gene from the state of North Carolina.
Hey, Gene.
Hey, Mary. The biggest issue I've seen really with our federal counterparts, just when it comes to the loan review side of the house, if we've got a remote into a laptop at the bank, their IT department is flexible when it comes to at times, but generally just fair warning that they may not have the flexibility some states do when it comes to promoting it.
So, Gene, you're breaking up a little bit, but I wasn't sure if the state promoting into the bank or the federal agencies direct connect to the bank.
Is that better?
Yes.
Okay. So the federal agencies, FDIC and Federal Reserve, they don't have great flexibility when it comes to remoting into a bank's laptop for off-site loan review. So typically we do something up front, and as of late, we've had some difficulties with them getting online, so we've had to restructure the exam team so that they focus more on the CALs, and we pick up the loan review because of the hurdles they have to try to jump over to remote in.
Okay, is that causing any resource issues on your department? That if you
No, not at all. We've been able to cash 3 or 4 weeks out and shuffle as needed, so we've been pretty lucky there.
Okay. Excellent. I hadn't heard that one, so thank you.
Yes, ma'am.
Teresa, I'm gonna unmute you.
I can comment. So we had our very, very first joint examination with the Federal Reserve, like that first or second week that COVID started in March. So either the third or the fourth week of March, we started a joint examination remotely with the Federal Reserve, with the Federal Reserve in the lead. That examination, the scope was scaled down significantly because of COVID and the unknowns, and it wasn't just the regulators that were thrown into a remote process. It was also the bankers that were thrown into a remote process. So to kind of really not cause too much burden on them, the scope was really scaled down. But I will say we are currently conducting our first joint examination with the FDIC since COVID. And the state of Maryland is in the lead, and it's going much better in the sense that the scope of the exam is not really scaled back. We're still doing everything that we need. I think that the loan review is always what tends to be a little bit more challenging on an examination because of the loan files. But I would say overall it's going very well. FDIC was like really wanting to know like what our process was about remote versus going on site and whether we were going on site. And I think we got asked 10 different ways how that was going to be happening. We gave the same response. We're doing everything remotely until we get the word that we can go on site. And even if we do go on site, we explain to them our entire examination team will not be on site. It may be 1 or 2, maybe possibly 3 individuals, not even entire weeks, maybe a couple days here and there just to do what they need to do. And of course, they would strategically schedule their days on site to be most beneficial on site. But so far, it's been going very well. I haven't really heard any complaints from my EIC or any of the other examiners, but the examination has not concluded, so I don't have a full report on that yet.
Excellent. Thanks, Teresa. And that is in line with what we're hearing. The FDIC is really still wanting to do full scope examinations and not really cut back, where the Federal Reserve is more risk focused on COVID impacts and are willing and doing some scopes. And that is, the states are doing a little bit of both across the country. So that does align with what we're hearing. So thanks, Teresa. And I do see where someone put in the chat that they're running into instances where the FDIC is adamant on downgrading earnings. And we're hearing that as well. And just, you know, if you want to add some comments on how you're working through those downgrades, if the state is not willing or wanting to downgrade, how are those conversations going and what's being worked out? And this one I hadn't heard yet, where the bank went ahead and adopted CECL and is getting penalized for being proactive. But I would be interested in which agency that is. But thanks for sharing that, Susanna. Any other comments regarding joint examinations or what you're hearing with the Fed and FDIC? All right, I know we have about 10 more minutes, and I know we have to get through a quick demo of Project 5, but just wanted to turn it back over to Jamie to talk about a little bit from an exam tools or exam resources, what is available through CSBS for you all.
So as it relates to exam tools and resources, we have the CSBS data analytics platform that has been, it has disaster information, COVID-related information, small business information that's definitely helpful during this time, especially evaluating business portfolios. We also have the CSBS COVID Examiner Resource Center, and this is a platform where states have been sharing current work programs that they have implemented, best practice documents that they have implemented. This is where you'd find the ED module for the interagency examiner guidance that Connecticut developed. So this is really a platform where states have been able to share stuff that they're doing within their states to help other states that might want to take advantage. We also have on that page federal guidance that's been issued, as well as fact sheets that we've issued since the pandemic. So it's just a good one-stop shop for examiners to access information. We also have the Examiner Yammer site. Now, this site was stood up as part of the COVID steering group to really get examiner feedback on the interagency guidance, essentially a platform like we're discussing today. What's working, what isn't working, where do you need help, what areas of review are, concerns, things of that nature. So we currently have 100 state participants in that from 25 states who are active on that platform. So if you'd like to join, it's something that you'd work with your state to gain access to. So the last item here is with Project 5. So many of you are aware that Project 5 was developed by the FDIC about 5 years ago, and then about 2 years ago through the FFIEC Exam Modernization Project. The Project 5 was also shared with all the agencies, and that's where they developed a schema for what types of loan information across all agencies would be beneficial. So with that, the FDIC was able to move forward with core providers and work with core providers to develop what was called a Project 5 file, so that bankers could share this file with the examiners, and through a viewer that the FDIC developed, examiners would be able to read these files seamlessly, because there wasn't a consistent loan imaging protocol across all financial institutions. So we've been hearing across some states that banks are purchasing these 5 files. They're rather expensive. So once these files are produced by the core provider, the bank is able to share that with the FDIC because they have a 5 viewer. However, states are now getting thrown into a situation where they're either on a joint exam, and because the financial institution purchased a 5 file, they're being told that they can't view any of the loans because they don't have the ability to view the files. However, examiners can view Project 5 files. So if you see on this slide here, we have requested loan approvals file and additional documentation file. So what the core provider does is they will, the bank will instruct the core provider which loans are being reviewed. So the core provider will pull those loans, and then any other additional documentation is placed into an additional documents folder. So if we look here, if you were to click on the requested loan approvals, you would see a list of the loans that you requested, and these are PDF documents. So if we were to click on Babel LLC, what you see produced is the entire commercial real estate loan proposal for this specific loan that's being reviewed. If you wanted to see additional documentation for that loan, whether it be financial statements, appraisals, credit memos, you would navigate the additional documents folder, and all those documents are tagged within that file. However, it's just just a PDF number. It's not tagged like the loans were. So you'd have to end up clicking on these documents to see which loans they may correspond to. However, if you were to click on just one of those documents, you're going to get the entire appraisal for that one loan. You're not going to get additional appraisals all in one document. So it really does break out each one of the specific loan documentations. So you could end up tagging them yourself, but we wanted to show you that state examiners can view the documents that are produced in a file 5 file without having a viewer, because they are just strictly PDF documents that you can just open on your computer.
Any questions on that, or any comments or thoughts?
I have a question from the chat. So the question is this a tool the bank could use for the underwriting process, or is it only to be used to assist in loan reviews? Also, it's going to be available to external audit review firms. You can come up with ways that this is worth the money.
Yeah, so I would just respond. So that's a good question. So the Project 5 standard file is something that the FDIC reached out to the service providers, as Jamie mentioned, and it is just an option for banks. It doesn't, the Federal Reserve doesn't have the Project 5 viewer, states don't have the Project 5 viewer, but some banks are purchasing it. I don't think that they are aware that right now only the FDIC has the viewer solution. And it costs anywhere from $3,000 to $6,000, depending on which service provider the institution uses. We've had conversations at CSBS with the agencies on if this standard file is going to be a file that more and more banks purchase, or if service providers stop charging the banks and more banks are able to use it. Maybe CSBS should look at developing a viewer, just like the Federal Reserve should develop a viewer. So, I mean, the purpose for Jamie showing you today is that we are starting to hear banks asking states to use the file, and states are responding that we don't know how to, we don't have the solution. So we just wanted to give you the information that yes, it's not as user-friendly if you did have a viewer like FDIC, but you can still work with the file if the bank is saying we can produce the Project 5 standard file. Jamie, I don't know if you had anything else to add. Sorry.
Nope, that's what I was going to say. Any more questions?
I see we're at 2:30, and I know that's at our time. We're happy to stay on to talk about other areas or receive other comments regarding anything that we've talked about today, but we also recognize that you are busy and you need to get back to your regular scheduled day. We will plan to continue these examination virtual discussions, probably schedule another one again in a month just to touch back. And as the data comes in and the situation changes, we want to just continue this dialogue. So Katie, if there's no more questions or raised hands, we can go ahead and conclude the call today.
I do not have any more questions or raised hands, so thank you all for joining today.
Thanks, everyone.